Who better than Gopal Srinivasan, the chairman and MD at TVS Capital Funds, joining in to answer exactly this. Gopal, hi, good morning. How have you been?
Good. It's
Great.
been I think Achay Din are coming for all of us. So we are all happy, is all I can say.
Okay.
बुरे दिन कब थे? All your investments have done so well. So what? A 10x has become 6x after the fall. So बुरे दिन आए नहीं थे.
No, actually for us, Achay Din were there. Achay Din are even becoming more Achay, is how I would look at life right now.
Okay, good to hear that. So I'm wondering, those on the street which did invest in some of these new age tech companies and those who were crying then after the IPOs and the way the stocks have fallen, it's really been all about the valuations, because that really was the good cop, bad cop kind of story. Are you willing to pay that price for a company which still has that many losses? But now, Gopal, you think some of these names, which my colleague was just highlighting, have fallen enough? Have they now come to the price where you'd be willing to buy them now?
Yesterday evening's closing price for fresh in US was $13.86. I always track my Chennai companies first. So that put them something like less than 4 billion valuation. So roughly we're looking at about 8 times price to sales on a forward basis. 8 times price to sales is where tech companies have been for the last 20 years if you take the large part of the time when there was no froth. So I would say, yeah, this is probably a good time to consider buying great companies. Is my opinion. I'm not able to see all of you, Aisha. Is it Aisha who's speaking?
Yes, that's me. It's Nikunj, and there's Nayantara as well in the Delhi studio.
Yes. So, Aisha, can I make some quick comments?
Sure. Go ahead.
I'm trying to offer and suggest, and maybe I'm wrong, but I would like to suggest a small framework to look at this entire set of issues rather than look at the issue themselves. First is, what is the time period with which we are reviewing this? Are we looking at it as a 3-month post-Ukraine lens? Are we looking at it as a 3-year post-COVID lens? Or are we looking at it as a 20-year lens? So that's my question number 1. My question number 2 is, if you're looking at it from a 3-year lens, you have a perfect trifecta, right? You have basically the economic damage of COVID. You have the liquidity sloshing that was created because to manage COVID, the amount of money that's been put in now being tightened and basically everybody raising the rates. And then you have basically a repetitive risk of Ukraine, which is giving people a tremendous amount of fear. So to me, the trifecta is COVID unleashed some kind of animal spirit to respond and humanity to survive as much as it created a recession. Liquidity being withdrawn and risk basically appetite becoming crazy because people are seeing repetitive events. Remember 2008, 2013, 2018 demon, 2020, now 2022. So that is creating a flight to safety. So I think that's one big factor that we have to see. That higher yields, people are moving to safety. The third point I wanted to basically make is that I think we cannot classify all startups. I'm talking now about private capital because that's what I understand, not publics. In private capital, are we defining startups as one animal, or are they like a normal distribution? There are great startups. There are some very sincere but not as capable startups. And then there are some people who are in the moral hazard regime who are basically starting companies, raising funds with the sheer idea of wanting to create valuation, right? People refer to them as fake startups. I refer to them as moral hazard of both the VCs involved as well as the startups, right? So in my mind, if we take the old-fashioned way, I noticed Vineet Sambre talking about how he invests in today's ET. Basically, the idea that you go back to fundamentals, find the great startups which are on the right side of the normal distribution, and focus on that sub-selection of the 7,000 or 8,000 companies which are getting funding, I think we will basically be in a better position. Those are, remember, Amazon made its first profit, even if it's 1 cent a share, in 7 years from starting. So clearly making good businesses which make profit are inevitable. We should distance ourselves from this trifecta of these 3 elements that we are seeing, which is creating a flight to safety. Identify what are fundamentally great companies, like the ones I think we are fortunate to have had and privileged to have had in our portfolio in fund number 3. And we should basically then make logical decisions with a Vineet Sambre, Warren Buffett kind of mindset which fundamentally looks at fundamentals of each company, like Nykaa, fabulous company, Delivery, fantastic company, absolutely great companies that I could straight away think. Freshworks, obviously, fabulous company. And in these three, I know. I don't want to comment on companies I don't know. But these are great companies. So I would say look for the right timing now. And if you're coming to 8 times price earnings on a pure tech business, price to sales, sorry, it's really a great time.
Fair point.
Sorry for being long-winded, Aisha, but I just thought I've been thinking about this a lot and I wanted to share my framework.
No, thank you very much. You've got, all of us thinking that yes, the word value is something which is now finally appearing in the entire tech space, so to speak. My follow-up question is that the realization for a lot of promoters now, when they've moved or when they've moved from the private market to the public market, is that the benchmarking is done differently. In the public market, it is about customer acquisition, relevance, and growth. In the public market, it is about cash flow, profitability, and path to profitability. Do you see the mindset changing? Because that is the debate. Nobody is talking about whether Zomato is a great company or not, or the relevance of Policy Bazaar. It is just the fact that how these promoters will have to take a rebirth the minute you go public.
Nikunj, absolutely agree with you. Fundamentally, the transition from privates to public, right, is fundamentally a change in what the investors are demanding from you. When you're in private, you go to a board meeting and basically you hear about what's the customer acquisition plan, how will my valuation curve go up, right? Essentially, trading valuation curve as if it was a security is really what is happening in privates, right? So when it comes to public, as you said, now you get mature, large investors coming to you and fundamentally asking you for saying, give me your 4-quarter projection. When will you get operating cash flow? So these companies will start behaving like that, right? Already, if you see Zomato's conference calls, they're talking more and more like a public company. So I think that is eventual. But Nikunj, I want to add one small point, if I may, on a macro basis, which is kind of the world I like to live in. Today, the market capitalization of private capital markets in India is about 20 trillion rupees. The public markets are maybe, I don't know, somewhere in the area of 180 trillion, 200 trillion rupees. So privates are becoming about 10% of public, right? So I think it's good for, stars like all three of you, Nayantara, Aisha, Nikunj, to think about having not a startup show, but thinking about asset allocation and saying private asset allocation, public asset allocation. And you are seeing more and more. We just had an annual client meeting on Friday, and it was full of basically insurance company CIOs. So basically thinking about the fact that privates as a category rather than startups as a category, and thinking about capital allocation in a disciplined way, there is a democratized interest. Everybody in the HNI group and UHNI group also wants to put 1 crore or 2 into privates. So I think privates is an emerging asset class. It demands attention. Today, it is at 20 trillion rupee or 15 trillion rupee. It will become 30, 40, 50 trillion. Remember, entire mutual fund equity industry is only 35 trillion rupee today, So 20 is not a small number.
Now, how do you see the compulsions at play? The compulsions at play for some of the PE players are that you ultimately want to make an exit. And that is the reason why some of these companies were going public. Now that this entire valuation in the public domain has got everybody thinking, what happens to the public market? What happens to the underlying valuation in the private market?
I think that's why I said अच्छे दिन भी आएंगे. Fundamentally, it definitely get reset to sanity. There was a whole hedge fund mindset that had come in some select companies where people were just trading the next valuation round regardless of what the business was doing. Or rather, the business was being made to do what would increase only the valuation curve rather than build good businesses, right? So great founders, however great they may, will be under huge pressure from all these companies. In fact, I'm more and more used to be a person opposing the idea of differential voting rights. More and more, I'm now getting convinced that founders should be given super majority rights in all these companies so that they can do one voice of sanity of what is good for the business and not try to get people into this valuation curve mindset. So the valuation curve is corrected like everything else, which means those great founders will now be, raising money at some point at lower rounds. I do worry though, because from anti-dilution perspective, sometimes the founders get over-punished if there's a down round, right? So we'll have to give it some time when people are comfortable to see at least a sideways round or a slight down round or a convertible structure. But I do worry that for the founders more, I really worried more about for them.
Or Achidit, because right now what are we seeing? We're seeing SoftBank's Masa on stage during earnings saying, we will invest maybe half, if not 1/4 of what we did last year. We have seen what has happened with Tiger Global. Sequoia Capital, another large India VC, VC in India, is dealing with all kind of other issues. There are markdowns, there are mass layoffs. FOMO is turning into JOMO, joy of missing out. So I'm trying to figure out where you are seeing this better news, Achhe Din, coming from.
I would, in my mind, Aisha, separate out the hedge funds from the real investors, right? Tiger, Stateview, Falcon, and whoever else, I don't know. These are hedge funds, right? So their behavior is different. Their behavior is as a side pocket of a very large fund, hiring a Bain or a McKinsey to select 10 categories across the world, find the best companies, go tell them like Masa did, I'm going to give you money, Yahoo. And if you don't take my money, I'm going to give it to Google. So you decide whose money you want, right? I don't want to discuss that. I don't understand that. And it's a very different behavior from a Sequoia, who I think is an outstanding long-term investor, like Sequoia, Lightspeed, Axel, Matrix, amazing companies. So, and many outside India also. These are two different categories, right? So I think coming to your second point, the point on Sequoia, what are they dealing with? Look, we have risk managers, right? When we invest in a Series A, the founder who has great ambition, like Adam Newman, as the example that you gave, one or two are going to get into this mode, especially when the moral hazard is greatly increased with this valuation curve drive, right? Okay, I'm giving you 2 billion valuation now. What does that mean? You're accepting a 10 billion valuation challenge from me. Effectively, everything is 5x. So the founder gets into more moral hazard and some things go wrong. I don't think we should oversweat all of these things. If you make a list of listed companies and moral hazard, I think that will run many pages. So look at the number of SEBI cases pending against promoters, right? So I don't think we should overdo. Sequoia is a great company, and I think if these things happen, it's the exception rather than the rule. So I'm not too worried about that. So I just think Achhe Din will come because these great companies will now be available at more moderated assumptions. And the hedge funds, I don't want to speak for them. They are behaving in a manner which is not in line with the way the venture capital thinks. Please read Masa's story. And when you read this Power Law book, I'm presuming you met that Power Law and the Venture Capital Industry book. It's a great book. And there it talks about Masa's conversations with Yahoo. I think it's a great learning for all of us.
Oh, great. Weekend reading suggestion is over here. I'm certainly going to pick up that book. But it's heartening to see TVS Capital saying that better days are certainly going to come. We just started to see the entrepreneurial spirit being unleashed across India. So trying to track it through all of those bad headlines. We had a good debut of delivery. It'll be interesting to see if now someone like a Farm Easy will also flirt with the Lal Street as it is supposed to. Mr. Srinivasan, we're running out of time, my producer tells me. So I'd like to thank you once again for being live with us and for being so candid.
And Aisha, I hope to see you on a show called Private Capital soon.